Welcome to ForexTV.com's PM Exchange. It's Wednesday, January 30th. I'm Remy Hoki. Today we're joined by Ashraf Laidi, Chief Forex Analyst at CMC Markets. Good afternoon, Ashraf.
Good afternoon.
It's great to have you on Fed Day.
It's always a pleasure.
Well, the Fed reduced both the Fed funds rate and the discount rate by 50 basis points. This means the benchmark interest rate is at 3% now. And we did have one person on the Monetary Committee dissent, and that was the Fed's Fisher. But if you could tell us about the comments post FOMC and if we've seen any divergence in their language today.
I like to use the metaphor, which is basically everybody in the elections is talking about calling the troops home from Iraq. And I think the Fed here, they decided to take the troops from out of the war against inflation and take them to the war against recession or contraction, because the only few words they had on inflation was that inflation figures continue to improve, but we have to watch it closely. They still use the word as the language was pretty much the same. The only thing really they just took out was appreciable, referring to appreciable market distress or market declines during the intermeeting rate cut of last week. But Remy, the fact that they did 225 basis points in 8 days, this is unprecedented. And the fact that the stock market failed to close higher, this is a big problem.
Well, indeed, given the intermeeting rate cut we had last Tuesday of 75 basis points and 50, that brings the total to 125 basis points.
Sorry.
No problem, Ashraf. So let's talk about how this translates into price action for the U.S. dollar. Euro dollar hit a high of 1.4905 today, but it still hasn't hit the record high. So given that now we have the Fed decision out of the way and we have NFP coming up later this week, do you think we'll see a new high as well as break above 150?
There is a chance we could do that. Yes, there is. And tomorrow is the consumer spending, personal consumption. And it is expected to go from 1.1 to 0.1. So there's a very good chance that it's going to go from 1.1 to -0. And that's a very bad sign, because that's what everybody's worried about. What does it mean for the consumer? And if that number comes in at 8:30 tomorrow below, you're going to see dollar yen hit across the board. Euro, we could really go above 149. 149.40, 149.80, and there's a good chance that we could, if the ISM on Friday after if the payrolls, if unemployment remains above 5%, and if the ISM remains below 50, definitely we could see 150. Oh yes, but I do like the actually euro. I would really like to play euro versus the sterling also, yeah. But maybe we can talk about that later. I think you have the charts there. Okay.
Yes, we do. Okay, well, since you just brought up euro sterling, let's move on to that currency pair. Rate differentials at this point in time are being closely watched. So if you could give us your forecast for euro sterling right now.
Yeah, the euro sterling, I put a chart there and I said 94.90. I think we are now 94. We went from 94.60 to 94.70. That means the €1 euro is worth 94 pence, 0.7. We all know the sterling went up and everything went up against the US dollar, but we all know about the fundamentals are really weak in the UK. But when these numbers come in and when the ECB is telling us that we have to be firmly against inflation, especially tomorrow we're going to see inflation above 3% tomorrow, 5 a.m. in the Eurozone. I think there is a very good chance that we could go back towards above 70, 75 and all the way to 70, 75, 20. So that's why I like the euro, but particularly against the sterling. And against the yen, I'm not so excited against that. Why is that? Why is that? Because the fact that the stock market today failed to break above 1370 and actually ended lower. Risk appetite is so sick, meaning that is good news for the yen. So you don't want to really buy anything against the yen.
Okay, well, as you mentioned, U.S. equities initially rallied after the Fed rate cut, but we saw that the major indexes all closed down in negative territory. And we saw dollar-yen pull back below 106.40. So as we head into the Asian session and into the New York session tomorrow, what do you expect to see in the pair?
I think I should have added one more chart there, which is the dollar-yen. I'll tell you why. When the Fed gives such a big rate cut, what does that mean? Is that good or bad for the dollar? When it gives a big rate cut, is that good or bad for the dollar?
Initially bad.
Initially. It is supposed to be bad for the dollar, especially dollar yen. But when the market does not react on that, and risk appetite drops. Is that good or bad for the yen? It's good for the yen. So it's a double whammy for dollar yen. So we could really see dollar yen probably go towards all the way to 106.20 and even maybe 106. I wouldn't be surprised if we break below 106. We went all the way from what, 107.20 to 106.48.
Yes.
So you see what I mean? So basically this play, dollar yen, it could potentially go all the way towards 106.20 and even 106 figure. And so people have to watch that out. And if the numbers tomorrow come in at 0.1, even below 0.1, it will be very bad news. We could be looking at 105.
Okay. Well, let's move on to the dollar block currencies. While we're still on the topic of the yen, let's start out with Aussie dollar and Aussie yen. The Aussie pulled back sharply from highs near 90.11 today, but now that we have equities closing lower and we had the Fed rate decision, so where do you see Aussie headed?
It's, against the dollar, we could potentially test an 89 and break below that and go towards 88. I have 88.80 and 88.50, however, I am more bearish Aussie against the yen. I think really 88.80, 88 probably 60 is a nice support. Maybe there could be probably some fresh buying again in the US and the Aussie that will lift us back above 89, and we could all we could go back towards. I mean, not lift back, not that we have fallen below 89, but if we break. And go really back towards 89.60 and 89.70 because it still remains a dollar story. It remains a dollar story, and that is very important. And I think that if people want to play this up, they could probably, if they want to buy something against the dollar, would be the euro, would be the Aussie. But I think the yen is really calling the shots right here.
Okay, and last but not least, before we wrap it up for today's interview, I just want to take a step back and look at this morning's U.S. data.
Yes.
We had Q4 advanced GDP come out, which brought the 2007 annual rate down to the lowest since 2002. But we also had ADP figures, which came in stronger than expected. So at this moment in time, what is your forecast for non-farm payrolls?
It's a tough one. Look, if the ADP continues to have this good tracking record, that means that what? What was the last number? 18,000?
Yes.
What does that mean? We're going to go from 18 to 70? Are you going to see the market cheering because we got 70? I mean, how ironic is that? I think the key, everybody should pay attention to this, is that it's not only about the payrolls, it's about the unemployment rate. So I think that, if we go from, if the ADP correctly predicts that we go from 18,000 to 70. Okay, that's fine. I think we could go to probably 70 or 80. But if we go to 70 and the unemployment rate remains at 5%, forget the 70, forget the 80. That is bad news. So that could be quite negative for the U.S. dollar, and that will, and don't get me wrong. At the beginning of the interview, I mean, I agree with the Fed what they did. So probably they can come ahead and say, well, we were right. We did 50 basis points. But what the market thinks is another different story. It's not the fault of the Fed, and this is what people have to pay attention. And I really do think that we're going to close. We're going to move quite negative in Asia. So I really think around. I'm thinking about probably around 5%. The question is, will the unemployment rate of December be revised down from 5 to 4.9, and will January show 5%? As you know, the unemployment payroll has 3 components, and it makes people crazy. And if people are going to try to trade right after the number, they don't know what to follow, right? But so I think that probably the unemployment is really going to be the key. Okay. Obviously the payrolls, but the unemployment rate. So, I think that people should probably wait, take a deep breath after the unemployment and after the employment report on Friday and see what's up. But because also at 10 a.m. on Friday there's the ISM, and if that remains below 50. Yes, we could be waving the flag of a recession right as we speak.
Well, Ashraf, you just mentioned revisions. What if we see a revision to the December numbers? And we have been seeing that jobless claims have been coming in better than expected. And tomorrow morning at 8:30 a.m. we get the jobless claims data for the latest week. So
absolutely,
what's your take on
that's a very good point. It's a very good point. The jobless, if the jobless numbers do signify and do trigger or make a good payroll number, or let's say they cause a revision, and if the payrolls, let's say, come in above 70, and if, let's say, the 18 was revised to 100, let's say, I don't know what the people are smoking at the Bureau of Labor Statistics, but we've seen this before. If that happens, definitely that could really help sentiment. It could help the dollar. even if we stay at 5% unemployment, it may help things. People will start arguing and saying, well, the Fed has done already 225 basis points since last year, and it is, and it's going to take a while for these things to come in and to trickle down to the to the U.S. economy. So that could help. But I think we had a piece in the Financial Times, in the View of the Day on Thursday, basically said that we do expect another 15 to 25% decline in the stock market. Basically, what had happened in the third quarter of last year in the stock market and in the second quarter should not have happened. Those gains, and I think we are undergoing a natural just paring down and cancellation of what had happened. And I do think there's another 20-25%. Just one thing I want to say. You see, a lot of companies are issuing strong earnings, or actually good earnings, but people are not paying attention to the earning, they're paying attention to the warning. Okay? So Yahoo, they didn't have a warning, but they had a sort of, they raised some cautiousness, regarding sentiment. I don't know what Amazon did, but we've seen this, I think, twice or three times, right? A company that has good earnings, people will say, okay, good. And then they say, wait a minute, but what about the future? That's very, very important. And if the dollar continues to do well against all these currencies, and if the euro, let's say, doesn't do so good, but just hold what it is, these companies will not continue to get the dollar translation effect they're getting.
Okay, Ashraf, thank you very much for weighing in on all the markets, especially the Forex market today.
Thank you. My pleasure.
This has been your Forex News with Ashraf Laidi from CMC Markets. Next up, we have your equities and commodities wrap-up for the day. U.S. stocks ended in negative territory after rallying post-FOMC. Wall Street closed lower, losing earlier gains. The Fed cut both the Fed funds and discount rate by 50 basis points and signaled that more rate cuts may be on the way. In today's U.S. data releases, advanced Q4 GDP came in sharply lower than expected. The Commerce Department reported that GDP rose at a seasonally adjusted 0.6% annual rate from the 4.9% reported in Q3. For 2007, GDP grew 2.2%, the slowest growth since 2002. And according to today's ADP report, the private sector added 130,000 jobs in January. The Labor Department will release non-farm payrolls data Friday morning at 8:30 a.m. Eastern Time. At the closing bell, the Dow Jones Industrial Average fell 37.46 to end at 12,442.83. The tech-heavy Nasdaq lost 9 to close at 2,349. And the S&P 500 fell 6.49 to close at 1355.81. In the fixed income market, U.S. Treasury bonds sold off as stocks initially rallied after the Federal Reserve rate cut. The benchmark 10-year Treasury note fell with a yield of 3.76%, up from 3.68% late yesterday. The 30-year long bond declined with its yield up at 4.44% from 4.36% late yesterday. And the 2-year note closed unchanged with its yield at 2.29%. In energy, crude oil futures gained, closing up above $92 a barrel. Initially, crude oil was lower after the Fed announced its rate cut, as some had expected a deeper rate cut. Earlier, the EIA said crude rose by 3.6 million barrels during the week ended January 25th. March crude rose 69 cents to close at $92.33 a barrel on the NYMEX. The market is concerned that energy demand may slow if the U.S. economy heads into a recession. Yesterday, the IMF projected a decline in global growth in 2008. Let's hear what the IMF's Simon Johnson said in his World Economic Outlook quarterly report.
We've reduced our forecast for growth at a global level for 2008 to 4.1%. That's down from about 4.9% in 2007. So that's quite a slowdown. And it's mostly driven by what's been happening in the United States and to some extent what we expect will happen in Europe. But we do think there's going to be a spreading of these economic effects throughout the world.
In other petroleum products, February gas futures added 0.45 cents to end at $2.334 a gallon. February heating oil futures rose 0.75 cents to settle at $2.54.93 a gallon. The EIA reported this morning that inventories of distillates fell 1.5 million barrels last week. Meanwhile, March natural gas futures added 10.2 cents to settle at $8.045 per million BTU. Over in the metals complex, COMEX gold futures surged on the heels of the federal rate announcement. Following the Fed decision, gold for April delivery advanced $10.10 to $940.90 an ounce in aftermarket trading. Gold earlier fell $4.50 to close at $926.30 an ounce. Meanwhile, other precious metals traded mixed after the Fed's cut. March silver rose 13 cents to $16.93 an ounce, while March copper fell 2.95 cents to settle at $3.26.95 a pound. And that's it for today's edition of PM Exchange. I'm Remy Hoki. Join us tomorrow morning for your latest news update right here on ForexTV.com. Have a good night.